When you look at some of the drawdowns we're seeing, how do you play what's next?
I mean, when you look at today, you can see that this is the first day in some time that we've actually seen all of those magnificent seven stocks actually down together. And we're definitely seeing some signs of profit taking. And I think that's really a reflection of more where the market is, where bond yields are, and some profit taking than it is on earnings results. You know, when you look at Meta's results last night, across the board, they were really very strong. And, you know, we've seen expectations tick up. I think the Magnificent Seven are very varied. There's a wide dispersion of valuations, and even companies like Meta that are traded at a discount to the broader equity market, they trade at a discount to other technology stocks, are being hit hard today. So it's not really about valuations, it's not been about earnings estimates, but just some profit taking. I think given as the market has been so concentrated, and we're seeing bond yields almost hit 5%.
When you're looking at the meta warning on economic uncertainty and you look across the technology sector, who do you think will be most hard hit in this scenario that has not been sold off significantly enough?
Okay, so, you know, I don't think Meta warned on the macro to be, I think, you know, Meta commented that, you know, after major conflicts, there's sometimes a pause or a slowdown. And actually their guidance for forward revenue bracketed exactly where consensus was. But when we came into 2023, earnings estimates for 2024 for Meta are for about $10. Now, as we're exiting this year, estimates are for $17. So we've seen that 70% increase in expectations already. So maybe some disappointment that those aren't continuing to go up. But I think, you know, given where bond yields are, given the macro uncertainty, not raising guidance has caused some profit taking. Obviously, with bond yields where they are, there's concern about the consumer, the stronger dollar in Europe. But, you know, we think most of the pressure that we've seen has not been on retail spend on smaller items, but on items where the consumer has to actually borrow. So that's not really been on advertising spend or smaller cap or purchases, but more in terms of where consumers have had to borrow, like autos, where we're definitely seeing a bit of a slowdown.
You know, talking about bond yields a little more, you do see a cooling today, but they have been extraordinarily volatile. How do you think that this will continue into the story when you're thinking about how tech responds to rates?
Well, you know, we think that in 2020, which obviously was a huge year for technology, money was free, interest rates were almost at zero, and it caused some irrational buying of stocks which are perennially unprofitable. But that higher cost of capital now is really causing investors, it's a great environment for active investors actually, because investors have got to really get back to fundamentals and focus on those companies that actually have the strongest balance sheets. And actually the technology sector has best balance sheet across all of equities. You know, Meta has over 25 billion in net cash. Alphabet has over 90 billion in net cash. And that means that those companies can not only continue to reinvest in new areas such as artificial intelligence and driving more innovation and earnings gains, but it also means that they can buy back stock and they can start to really return money to shareholders. And we saw that with Meta last quarter, buying over 3 billion in stock back, and Alphabet also continuing on that journey of shareholder return, which we think is really strong long-term support for these companies and for shareholders.
Are you seeing any buying moments right now, or do you think that it's just too volatile and the sell-off is yet to come still?
No, we think this is a great environment for active investors. And we do think that valuation discipline is more important than ever in this market, given the pace of innovation on artificial intelligence. I think if you're trying to look out for 10 or 20 years and pick winners in 10 or 15 years' time, and you're willing to look at losses every year, that's a very difficult environment. That's not what we look for. We look for companies that have strong balance sheets, strong positive free cash flow, who can continue to reinvest. And, you know, we do see some really attractive valuations, which are at a discount to the broader equity market for actually what is much stronger long-term growth.
How are you looking at this earnings season as well? We're looking forward to a host of more companies, Intel, Amazon. What are you going to be looking for?
look at, when you look at Meta's earnings, some of the key factors that came out of Meta's earnings were, the strength of engagement, that's the user engagement, how users react to the platform and the products that you serve. And efficiency, a focus on capital allocation. So when we hear Amazon's results tonight, again, that's going to be key. What are Prime members doing? How are they responding to investments in their regionalisation? And then we'll look at AWS. And I think the growth in AWS is going to be a key driver out of Amazon's results tonight. Expectations have come down somewhat from 16% growth down closer to 12% that people are looking for. And I think we're just looking for a stabilization in some of those optimization trends. After the strength that Microsoft saw in its cloud division, investors want to see that Amazon is also seeing some benefits of its investments in artificial intelligence as well, and that they are seeing some stabilization in the optimization that they'd seen from customers over the last year.